before we get going, if you've been trading Forex, maybe you already have a broker. There are two different ways that a broker can choose to have you position size. Typically, brokers will have you position size in some kind of lot size. And the conventional lot sizes that we see is standard, a mini, and a micro, right? And all of these are lot sizes. So you could say standard lot, mini lot, micro lot. I'm just abbreviating them here. And for a standard lot, the amount that makes up that lot is 100,000 units, right? And a unit would be, you know, a €1, €1, $1, whatever unit of the currency that you're dealing with, and that would be the currency in the quote. For a mini, it's 1/10 of the size, which is 10,000 units, and then the micro is a tenth of a mini, which then gives us 1,000. So this is something that you would just need to know. Most brokers, as I was saying, will choose to position size in something like this. And you'll see, even when we use the calculator, it will give us options of, do we want to have our position size in this kind of lot size, or do we just want it in units? And really the difference would be when we go to put in the position size, if your broker's using some kind of lots like these, then the position size might look something like this. And the way that you could think about this is, standards would be a full 1, a mini would be 0.1, you know, going down a tenth. So sometimes the way that they might have you position size is something like this, where it says, you know, I want my position size to be 1 standard, 2 minis, and 5 micros, or 125,000 units, right? So you'll see most brokers will have you position size something like this. Owanda is different. Owanda chooses to go the other way, and it's not very common. I would have to admit that most brokers are going to position size in these lots, but Owanda just has you put in an amount of units, right? So instead of putting 1.25, which represents 1 standard, 2 minis, and 5 micros, you would just say, I want 125. Just got my caps on. Units, right? So that's going to be the two different ways that you're going to see. Either they'll just have you position size in units, or they'll have you position size in these lots that stand for a certain amount of units, and then our position size would look like this. Again, 1 standard, 2 minis, and 5 micros. So that's the first thing that we're going to have to know about position sizing in the Forex market. The other thing is these pips. So unlike the stock market, the pips in the Forex market, or I guess what I should say is, unlike a cent, pips change depending on the value of well, not only the exchange rate of the two currencies, but also the amount of lots that you want to purchase. So over here is the price axis. This is where we see the pips and what have you, right? And these are actual values. The pip is that 4th digit to the right of the decimal. And we can actually use a web-based calculator to find the pip values, because they could be different from pair to pair. Sometimes they are the same, And more often than not, it's a coincidence. But we could, for example, go to Google here. Get my mouse. All right, I just went to Google and I searched for pip value calculator. And it gave me a whole bunch of different hits here, right? But this one is easy to use, this pip calculator, my FX book, right? And so this pip calculator here will actually tell us what the pip value is for all the different currencies. Now, your broker might not trade all of these, right? But the list is large enough that it also encompasses the highly traded ones, the ones that you'll see in pretty much every broker. So what you would first need to do is choose your account currency, right? So I'll just keep that at USD. And then this lot size here, right? So the lot size, I think if I just put 1, yeah, perfect. So the lot size here says toggle between lots and units. So I could have done 1 lot, which is equal to that 100,000 units. I might even be able just to put the units in there as well, but the 1 worked, right? That is just the standard lot. And then we're looking for the value of a single pip. Right, and so as I go down these results, you can see the currencies on the left-hand side, Aussie CAD, Aussie Swiss, Aussie Yen. It's all in alphabetical order as you go down. And then it gives you the pip value per standard lot, mini lot, and micro lot. So when I'm doing this, I like to use micro lots because it gives you more flexibility. Really, I like to use units. The smaller the unit goes, the closer you can get to your ideal position sizing. So for example, what I meant by unit was just any form of position sizing. So for example, if your broker only trades standard lots, but your account size isn't big, your risk isn't a lot, and let's say one trade you can only buy a half of a standard, then you can't even take the trade because the broker only trades in these large lot sizes that you can't even then engage on some trades, right? So it's always good if you have a broker that trades minis over standards, or even better, trades micros over minis, right? Because again, the smaller the unit, and that's one of the reasons I do like Owanda, is that it position sizes in units, so you can just get closer to that maximum amount of risk that you're willing to take on every trade, right? So this is where you can get pip values from, and you can also get them from your broker. There's a couple of different Forex brokers out there. I have Owanda opened up here just in case I needed it. But for example, if you're in Owanda, you want to get the pip value of Euro Aussie, I could come into this units box and just put 1,000 units, right? If I put 1,000 units in this box here, right, that's a micro. Remember, a micro is worth 1,000 units, right? So if I put 1,000 units here and it gives me this price here of 1 pip, that value is per 1,000 units. And I could do the same thing with a mini. Notice here how a mini is 74 cents a pip, and I could even bump that up to a standard here where it's $7.44. So, whether you're getting this stuff from your broker or a website, this is only really needed if you're going to do it by hand anyway. So not all that important, but I do like to go through this just in case you're taking notes. So when we're position sizing, there's a couple of things that we're going to need before we start that process. The first thing is we need to know how much cash we have in the account, right? So I like to use the balance. You want to be careful. On some brokers, they'll give you like a balance, they'll give you an NAV, they'll give you several different summations of your account. And the number that I like to use is the amount of cash without any unrealized profit or loss, right? So I only consider the realized profit and loss along with the whatever cash that I've had in that account, right? So the balance is going to give you that. If you use something like the NAV, that's going to constantly be changing as the trades that you're in are either gaining or losing, right? So I like to use the balance here, and we'll just say, let's say you open the account with $10,000 just to make the math easy, right? So if we know how much money is in the account or the balance of the account, then we're going to need to know how much am I willing to risk per trade, right? So we like to do a percentage of the account balance, right? And we know just from the courses that we don't want to really go above 2%, right? And for this example, we can use 2%, but definitely if you're new to trading, start slow, start at a much smaller percentage, and then just slowly build that percentage as you see that you're getting the method, you're getting the results that you're looking for. So for this example, we'll just do the max 2%, right? So 2% of 10,000 is 200 bucks, right? And we can break out a calculator really quick because I don't always trust myself with the math, but I'm just going to multiply by 0.02, which is 2%, giving us that 200 bucks, right? So I know my account balance, and then I know what I call my max dollar risk. Everyone calls this something different, but this is the max amount of money that I'm willing to lose for this particular trade, and we calculated that as 200 bucks. The last thing that we're going to need before we go through this process, just to kind of make it easier, is the pip value of the currency pair that we are trading, right? And again, every currency pair could have a different pip value. So it's important that, if you're going to do this by hand, I suggest you not, that you have to kind of every single time go and find those pip values. So I chose an example that's going to be easy. It just so happens that any currency pair that has the dollar in the quote, right? So when you're looking at a pair, you have the base in the front, you have the quote in the back. This would be an example of a pair that has the dollar in the quote. And any pair that has the dollar in the quote has a 10-cent pip value per micro. So just kind of made that easy for myself in this little example here. Okay, so I have my account balance, I have the max dollar risk and the pip value. So going into the process of position sizing, what we would first need to do is entry minus stop. And that's going to equal our pip risk. It's just the amount of risk that we have in pips, right? So notice that for position sizing, you have to know where your entry and your stop is, right? So position sizing doesn't really work for the traders that just jump into a trade without any plan, without really any kind of thought about it, just hitting the buy button. You would know your entry when you hit the buy button, but if you don't know where that stop is, then you couldn't have position size anyway. So this is really something that all traders should do, but you're going to see that some traders don't go about it this way because it's just too slow. If you're on a tick chart or even like a second chart, what have you, the market's moving so fast that you might just have kind of your own standardized position sizes that you do based on the pattern, and you just kind of do it that way so you can throw it in. So that's fine. right? But for proper position sizing, you do need to know where an entry is, where the stop is. Targets don't really matter because position sizing isn't impacted by the targets. Really, it's all about the risk, right? And your risk, the total risk of the trade, is between the entry and the stop of any trade, right? So entry minus stop is the pip risk. So what I did here is I chose a trade here. This is a nice little 50 charge on Aussie dollar daily time frame, right? We were kind of zigzagging higher, and here's a nice A, B, pulled the Fibonacci retracements. You can kind of see how we based here. So that's kind of what I'm basing this little trade around here. Let's just say we got in at this green line, we threw the stop there at the red line, right? So if I wanted to know what the entry minus the stop was, I could take that green line, 0.6435, and subtract the red value. Right, and when you do this in a calculator, oops, you're gonna get a decimal, as you can see here, 0.0065. So when we go about it this way, the calculator is gonna give us a decimal here, and that fourth digit to the right of the decimal is the single pip column. And then we have the 10 pip column and the 100 pip column, and then the 10,000 pip column, or excuse me, not 10, 1,000 pip column, right? So just kind of looking at this number, what we have here is 65 pips. One way that I used to like to do on the board is just kind of move the decimal 4 places to the right, and that will help you with these decimals. In a calculator, if you multiply by 10,000, you get that 65 pips. So basically what this is saying is that from the green line down to this red line, the distance measured is 65 pips. So that's step number 1. Step number 2 would then be taking that pip risk and multiplying it by the pip value, right? And that's going to give us a dollar amount, right, of risk. Yeah, I'll just say dollar risk per micro. And it's dollar risk per micro because we found the pip value of a micro, right? So if we would have gone and found the pip value of a mini, this would be dollar risk per mini or dollar risk per standard. Like I was saying though, I like to go for these smaller units or these smaller lots so that it gets us closer to that ideal position size. So with the pip risk times pip value, we know what the pip risk is. That was step number 1, 65 pips. Right, we also went out before this process and grabbed that pip value. Right, so the pip value for Aussie dollar, I'll throw the dollar sign in there, is 10 cents. Right, so 65 times 10 cents, $6.50. So what this means here, this $6.50, is that if I were to have purchased 1 micro at the green line and then I were to get stopped out, I would lose $6.50 on that 1 micro. Right? So step number 3 then would be if I'm willing to lose $200, knowing that each micro has a risk of $6.50, we could then figure out how many micros I'm able to purchase. Actually, before I do that, why don't I do max dollar risk divided by the dollar risk per micro gives us our position size in lots, the actual micros there. A lot of dashes or slashes there, but anyway. So if the max dollar risk is 200, each micro has a risk of $6.50. 200 divided by 650 gives us this many micros, right? So 30.77. Now, when we're working with micros, remember a broker choosing to use lots, micros are going to be the smallest lot, right? So there is no fraction of a micro. So at this point, the trader who has a broker that uses these lots would have to round down. That's what you would want to do to keep your risk under that $200. But the trader would have to basically round down to just 30 micros, and that would be their position size. Now I can turn this into units. If I know that each micro is 1,000 units, right, then 30 times 1,000 would be 30,000, right? So whether your broker did it in lots, you could do something like, if they did it in lots like IG or Forex.com, they all use lots. If your position size was 30 micros, then they would have you put in a position size of 0.30. And that 0.30 would just represent basically a third of a standard, which is about what we're looking at here. And then if you were using a Wanda, they would just have you put in the units, as we figured out before. 30 micros times 1,000 units would get you those 30,000 units. So for this trade, if we wanted to position size correctly to only have the potential of losing a max of $200, we would need to have a position size of 30,000 units for that trade, right? So that would be going about it by hand for the non-yen pair.